Hi, my name is Mayra Rivera, and I'm the founder of the Rivera Group at Century 21 Americana. And as a real estate professional, one of the most common questions that we get is, how do I begin investing in real estate? Where do I find properties? How do I get started? How do I purchase these properties? And as a realtor, I can let you know that you've already taken the first step, which is educating yourself. By watching this video, I'll be able to give you some of the basic points of what it is to invest in real estate, what are the ways to invest, and how do we get there. So the two main ways that you invest in real estate are by flipping homes or by owning rental properties. The first of the two most common ways of investing in real estate is flipping properties. So I'm sure most of you have heard it's very popular right now that people want to purchase properties to flip and make fast cash from those sales. So the way that those are done is you purchase a property with the intention of rehabbing it and immediately selling it so that you get your money back and you make a profit. So the way to purchase these is either you purchase cash or you have to find a loan that will finance you so that you can purchase it and then pay it back right away after you sell. So the cash is obviously going to be very straight to the point. You provide proof of funds, we find the property, you buy it. If you go the loan route, the difference between one of these loans and a traditional loan is that these loans will more than likely have higher fees, higher down payment, higher interest rate, and most importantly, a very shorter time frame for payback. You have to pay these loans back because the intention and the reason why they gave it to you is to purchase, fix, and flip, not to hold it. So that time frame is going to be very important if you're using one of these loans. These can vary, just like any loan. Once you acquire the property, the next step in flipping a home would be, and I would say one of the most important, is to keep your margins in mind. Keep in mind, you've already put in money, or you've got a loan where you put in your down payment. You've already put money into this home. You already have a price. The next thing to keep in mind is your next step is going to be rehabbing it. So you have to know how much money that part is going to cost you, and at the end, how much money you're going to make sure that your margins make sense. A real estate professional can help you find those properties and give you an idea of what that bottom line is going to be once you decide to sell it. Because you can buy it for a certain price, getting the bids would be important, and then at the end you have to have an estimate of how much it's going to cost you to sell. There is a cost to sell a property. So let's go back a step. We already know how to get the loan. So on the middle step, rehab. We have to be very, very precise on when you are in escrow, once you get an offer accepted, that you do intensive home inspections. We can have specialized contractors out to give you bids, handyman, painters, plumbers, whatever it is that that property has that you have to rehab, you have to know how much that's going to cost you, because that's going to be obviously taking some money from what you're going to be making at the end of the sale. So that middle piece is what we call a due diligence period, where we take your home inspector and any contractors, make sure you get all the bids and all the numbers in line before you decide that you're going to purchase this property. Another major step, which is that final third one, which we like to tie into the beginning, because you want to know that your numbers make sense before you waste time closing on a property that won't make sense for you at the end. That last step is obviously once it's ready to go, it has to go back on the market and it has to be sold. So that same real estate agent that helps you at the beginning find it, they will also help you at the end to put it back on the market to sell it. And selling a home comes with expenses, which we call closing costs. So there's different closing costs related to selling a home, like your real property transfer tax, escrow fees. There's commissions. You do have to offer a commission to the buying agent that brings you that buyer that's going to buy your property. Those numbers are also something good to keep in mind as your total expense. So now you have down payment, you have rehab costs, you have selling costs. Putting all those numbers together, as a realtor, we have to make sure that you're buying a property at a good price that will give you enough equity to cover all of those things and still make you a profit at the end of the day. And obviously, we have a time frame. So we have to make sure that all of this happens before that time frame, whatever the goal is that you set for yourself. For flips, the faster you flip them, the better, because the real estate market changes. If you take 6 months versus 2 months, you might have completely different markets. And that's something that we can talk about at a different time. That's the overview of flipping. The second most common way for investing in real estate would be rental properties. This is if your goal is to create a long-term passive income where you have properties that are rented and that you're receiving money from those properties every month. So these properties can also be purchased in the same way. You can either buy the property cash, so where it's owned free and clear, and then 100% of that is coming back to you, or you can have a loan. There's different loans for investment properties. Typically, you're looking at a 20% to 30% down payment if you're buying this house as an investment property since the beginning. And we'll come back to why that's important. If at the beginning it's an investment property, you're looking at 20 to 30%. So with these properties, once you purchase it, then obviously you're telling the bank this is going to be for rental purposes. The important thing on that is that you have to make sure that your mortgage is, let's say, X amount, $1,500, just to throw out a number. Then you have to see, and a real estate professional can help you, is in the area, how much are those properties renting for? That difference is going to be what we call cash flow, which is the profit that you're making from these properties every month. Another important thing with rental properties, if you chose to go this route, you can either self-manage or you can hire a property manager to manage these properties for you. Self-managing means you do everything. Property manager will typically cost you 10% of whatever you're renting that property for every month, but they will take care of not only listing the property, making sure it's ready to be listed for rent, the pictures, they collect applications, they screen the applicants for you, they will do credit checks, they will make sure that they check employment, and then they present to you, here's all the applicants on your property, so that you can pick which tenant is the one you're going to sign a lease with. That is definitely helpful if you don't want to have your hands involved at all, because they will do everything. The tenant will not contact you, your property manager takes care of it. If you have multiple properties, then that's obviously an advantage that you don't have to worry about. The only thing that they will come back to you for that is not part of your 10% is, let's say you had repairs, like a major repair, the AC went out. Then the property manager still takes care of communicating with your tenant, getting the handyman out there, HVAC tech. They'll get those estimates, bring them back to you as the owner, and they help you negotiate repairs and navigate through any problems that arise with the rental property. But they're the main point of contact for the tenant. You don't have to worry about it. That's the two ways to manage your rental properties if you chose to go that route. There are some benefits to having rental properties, and here's some of the main points, just to be brief. Obviously, you're making cash flow. Cash flow is going to be one of your main points. You have a property that's making you money, so you're getting that money every single month deposited into your account. The more properties you have, the more income that you're getting. Number two is if you are financing this property, you put your down payment in, but you're not paying that mortgage, the tenant's paying it for you. So in the long run, they're paying down that loan for you. This property is being not only paid down, but it's also increasing in equity, just depending on when you sell. So you're gaining equity and you're getting this loan paid down for you. At the same time, you're getting cash flow every month. That's a major benefit of having rental properties. A third one that's very common is obviously you have tax benefits. You can sit with your CPA or a tax preparer and they can give you some ideas of what the tax benefit would be for you. That varies depending on your financial situation. Another one would be that these properties are, throughout time, they're appreciating in value. So let's say you bought a property now and you've rented it for a few years, and down the road you have plans for yourself to do something and you want money to do it. Let's say you're opening a business, for example, and you need to fund that business. You can pick one of your investment properties that has already gone up in equity, that you have money there. You can sell that, take that money out and move it to other investments. So that's obviously one of the reasons that a lot of people like to have that, because you have a lot of options and things to do with those properties. Another thing that I would mention on these properties that's important is you have to be, since you're going to be holding these for the long term, is what kind of investment property do you want to own? Do you want to have single family, which is a house, and you're renting to one family? Do you want to go to fourplex route, where you have 4 different units? There's also townhomes, there's also condos, there's different options. And we can go over those if you have other questions. That would be a very extensive different topic. Another thing just I wanted to mention, as I mentioned at the beginning, you have that 20%, right, that you're coming in. Another thing that people do, especially maybe right after graduating from college, or this is your first time home, maybe you and your spouse want to start something small. A lot of people will buy their first home as a primary, and after you've lived there for the time that the bank requires you to, let's say you bought a starter home now, and you're like, hey, this isn't my forever home, this is my starter one. Then there's options to buy that with the normal traditional loans, 3% to 5% down payment. You live in it for your primary a few years. Let's say after 2-3 years, you say, hey, I'm ready to upgrade for my bigger home. We're expecting a baby, or we want to upgrade something bigger. We want to move closer to work. Or hey, I'm already into my career, my profession. I'm making more money. I feel comfortable with a bigger payment. Then you can keep that property, turn that primary one that you had, the starter home, into your first investment property, and then just move on to purchase your next primary home. Now, you have that starter home that you came in with very little money as your primary that just turned into your first investment home. So now that you know the most common ways of investing in real estate, then the first natural question is, how do I get started? This is my first time buying real estate. I don't know where to begin. So first you have to determine how you're going to be purchasing this. Is it going to be cash, or is it going to be financing? If it's finance, you're going to have to qualify for a loan. And if it's cash, all you need is your proof of funds. Proof of funds can be either the first page of your bank statement that shows your balance, or it can be a letter from your financial institution that says this person has X amount in their account. What it is just proof that you have the money to purchase this house that we can show to the seller so that they know that the funds are available. Or the most common one that is used is financing. If you're going to get financed, we would get a pre-approval letter, and with that letter, that's what you're submitting when you're sending your offers. How do we get this letter though? You're brand new, you have never purchased a home, right? Your first step, and that's something that you can begin right away, is make sure that you have a good credit score. Credit can be one of the things that takes the longest to create. So most of these institutions will require a 640 or above FICO score. Make sure that your score is up there. The higher the score, the better interest rates that the banks will offer you. So that's number one. The next thing would be to save money. You will have a down payment. They're going to finance you for, let's say, $400,000, but they're going to ask you for a percent in down payment, just depending on what loan you're picking. These percents for an investment property are 20% to 30%, or if you went on your primary home, it could be anywhere from 3 to 5%. There's different programs, but you do need to save money because you will have a down payment to purchase these houses. After you save your money, then just make sure that that is seasoned in your accounts. The lender, the bank, they will check that you have the money available as well to cover that down payment. The next thing that I would recommend is you need to have an employment history. The bank is lending you money, but they want to know that you have a steady income or a steady employment that is going to repay them. So generally, they're going to ask you for 2 years. So that can go 2 routes. If you're a W-2 employee, it's pretty black and white. Here's my pay stubs. This is how much I get paid for the last 2 years, and it's pretty stable. They'll go off of that. Or if you are a business owner, self-employed, or you get paid on 1099, then those have a little bit different ways of looking at the loans, but most importantly, you want to make sure that if you're a business that you're actually reporting income. They're going to go off of what's the net that you made after your expenses, not before. So that's a very common mistake that a lot of people do when they own businesses. They'll write off a lot of expenses to where at the end your income is very small. The bank is going to qualify you based on that income. So that's something good to keep in mind. Another thing, well, the next step would be, once you determine which route you're going to take, which one of these two you are, then it's getting the pre-approval. the bank is going to ask you for documentation. They want to verify your employment. They want to run your credit to make sure what that is. They want to verify your pay stubs if they apply, your bank statements that you have funds. If there's other situations, if you receive, let's say, money or income from other sources, they want to know what those sources are. As I mentioned earlier, one of the benefits of rental properties, remember, if you do have rental properties and you have that income coming in, that can be used as income as well, aside from your job. Let's say this is my job, this is my income from my career, my job. Then on the side, I have 3 rental properties that bring X amount every month. If you provide your tax forms that show your rental income, you can add that in there to increase your approval amount. Another thing on getting your pre-approval is once you have your pre-approval ready, you've met with your professional, you have a plan set, then the next step is finding properties. And the most important thing here is patience and having a very clear goal of what you're trying to do. So some of the scenarios that you might go through require a little bit longer time. Let's say, for example, if you're finding a flip, you have to work with a real estate professional that's going to give you the patience, as well as you have to have the patience to find a property that's going to fit, that those margins are going to make sense. It might not happen from one day to another. Or at the same time, if you do have these properties that come up and they're amazing deals, then you have to be prepared to send those offers and to show the seller that you're ready to purchase this property so that you don't lose the opportunity. So I know it's a common myth that some people will say, well, I want to go see the house first and then I'll tell you if I want to qualify. I highly recommend the other way around. You want to make sure your financials are set. You want to make sure you have your proof of funds or your pre-approval letter. So if the opportunity does come up, you're not wasting time scrambling for your documents to barely get these forms, because an offer without one of these is not always a strong offer. If they have multiple, like in certain markets, if they have multiple offers on the table and yours is missing your proof of funds or your proof that you have a approved loan, then your offer is not as strong as the others. So it's always good to be prepared. Another thing when it comes to these is obviously your inspections, as I mentioned before. So once you get your property in, then the next step would be making sure you know how much it's going to cost to get these inspections done, what the things are that you're going to be looking for. And finally, how long does it take? If you're cash, it's going to take, I'd say probably average 2 to 3 weeks, just depending if the properties have HOAs, because HOAs we have to order certain documents. If it's cash and it doesn't, or if they already have the documents, it could go fairly quickly. Also making sure that the titles are clear. So we have to make sure title's clear, there's no liens, judgments. We make sure all of that stuff is good before it transfers to you. So I'd say probably 2 to 3 weeks just to be safe. And if you're financing, it's typically going to be between 20 to 45 days, just depending on what type of loan. And same things over here, making sure title is clear and everything is good. HOAs, you've done your inspections, we've done your appraisal, that all of those things line up before we're ready to close. So that's it in a nutshell, what it takes to qualify for a loan. I hope that was helpful, and if you have any further questions, feel free to let me know.